See that? That's the moon. That's where we're going. So, stocks are securities that give some ownership share in a company. They're referred to as equities because in a company, if you own it, you have a residual claim after liabilities are paid. So, in a company, you have assets and liabilities, and equity is an ownership claim of those assets after liabilities. Now, what are those assets worth? You could just look at all the things a company owns and say, well, we know the price of this, so the company's worth that amount. But there's a lot more to a company, how everyone in the management team has been able to grow things, the knowledge base of the employees, the market share it has, its innovation, its brand. So there's a lot of work that goes into trying to find what the value of a company's equity is. And I will be going further into the evaluation of how much a stock should be worth. But it isn't usually that exact. And there can be some real disagreement as to how much a company is worth. So I want to go into just a general overview of stock markets to begin with, why they exist, and how they work at the most fundamental level. So why do they exist? Well, if a company needs to raise money, they can sell off equity shares of themselves out into the open market, and there, buyers can decide how much they think the company is worth and pay that. Now, initially, in an initial public offering, there's a price that the stock is first sold into the market at, and from there it can go up and down. So, what we end up having are these open markets where investors are able to invest and make money, companies are able to raise funds, and overall, the capital in an economy is able to go from investors to companies who are able to deploy it in ways that benefit the economy as a whole, allowing the investors, the companies, and the whole economy to benefit. So, how do they work? Well, companies initially sell their shares to the market and get money in return. And then from there, you have a number of different participants, some of them who end up having pretty niche roles, but in general, you have buyers and sellers, people who want to buy the stock or sell the stock, and it's the relationship between those two that ends up getting at what the price is. If more people want to buy, then the stock price goes up. As more people are willing to buy more at higher prices, then the price will keep going up. And then people start to sell, perhaps, and the price will start going down. But the buyers and sellers can't directly interact with each other because these are people all across the world. So you end up having brokers. And what brokers do is they match buy orders and sell orders that they receive from clients, or they might be able to fill the order themselves if they have the stock. And they make money through a spread, the bid-ask spread. For example, they may offer that you can buy a stock at $100.01 and that you can sell it at $99.99. And for really heavily traded stocks, usually this real small percentage is not much of the overall price. But when shares of a company are barely traded at all and become much harder to get transacted, then you'll tend to see wider spreads between that bid and ask price. So to the point of liquidity, we get to the concept of market makers, who are generally large financial institutions who make sure there's liquidity in the market. They will buy and sell chunks of securities, very often net being really neutral, where their long position and short position cancel each other out, just making sure that there's always a supply that exists in the market so that people are able to trade it. So, how do you know how much a stock is worth? To get into this, we have to introduce the concept of discounted cash flows. So just like in the video on interest rates, think about the rate of return over a year. If you have $1 now and expect that in 1 year you will get a 5% return, then you would expect 1 year from now you will have turned that $1 into $1.05. Well, we can ask that question in reverse. If you expect that something is going to be worth $100 in a year, and that the rate of return is 5%, then how much is it worth today? Well, when we moved it forward in time, we multiplied by 1.05, 1 plus the 5%. To bring it back a year in time, we divide it by 1.05 to get the current value today, which is $95.24. $100 in 1 year is worth $95.24 at a 5% rate of return. Now, so far, when talking about moving money forward and backward through time, there have been terms like interest rate, growth rate, rate of return. Now, these terms all mean different things. But this activity we're doing of moving money by a certain percentage forward or backward, that rate can be generalized as the discount rate. We are discounting these cash flows by, in this case, a 5% discount rate. Now, so far in these videos, we've been using examples where the investment time horizon is 1 year, but in most investments, the time horizon isn't just 1 year. So let's try this again with 3 years, where each year you get $100. So we know $100 1 year from now, with a rate of return of 5%, we divide that 100 by 1.05. So we have year 1, year 2, and year 3 with $100. So let's start from the furthest year first, year 3. For right now, we're saying the rate of return each year is 5%. So let's take year 3's $100 and bring it back to year 2. We divide it by 1.05. Now it's at year 2, divide that by 1.05. Bring it back another year, divide it by 1.05. So that $100 in year 3, we have divided that by 1.05 each time for each year it goes back. Each year it makes that 5%, we bring it back by dividing it by 1.05. Same with year 2. We'll take that 100, divide by 1.05 back a year, and divide that by 1.05 back a year. Then year 1 we already know, we divide that by 1.05 and just bring that back 1 year. But that's a bit clunky, so we can say it more simply. Year 1, we divide by 100 by 1.05. Year 2, divided by 1.05 to the power of 2. Year 3, divided by 1.05 to the power of 3. So each time we did that, we simply said that dollar amount in that year divided by 1 plus the rate and raised that to the power of however many years away that is. So in this case, in year 3, we got $100 and divided that by 1.05 to the third power, which gave us $86.38. In year 2, 100 divided by 1.05 squared, which gave us $90.70. Year 1, $95.24. When we add them all together, we get $272.32, which means that $100 each year for the next 3 years at a rate of 5% is worth $272.32 now. So when we apply this to stocks, the question immediately arises of what makes a stock have value. Well, maybe one place to start would be dividends. Many stocks pay out a dividend, often quarterly, so that could be a place to start. Those dividend payments, how much are they worth today? This introduces the dividend discount models. So let's say a stock is paying $7 for its dividend, and the rate of return you need is 4%. Well, let's do what we did in the last example and say each year you're going to get $7 and then divide that by 1.04 raised to the power of however many years out that is. But let's add something to it. Let's assume that the dividend is going to grow. The company is growing, it can pay out a greater dividend. So let's say the dividend is growing at 3%. So that dividend, first year multiply by 1.03, then 1.03 squared, then 1.03 cubed, then 1.03 to the fourth power, and then we'll do that same step again, each time just having the 7 grow before we divide it by 1.04 to the power of whatever year it is. So 7 times 1.03 is $7.21. Divide that by 1.04 and we get $6.93. $7 times 1.03 squared divided by 1.04 squared, we get $6.87. Third year, 7 times 1.03 cubed is $7.65. Divide that by 1.04 cubed, and we get $6.80. And then again for the fourth year, $6.74. So we add that all up, and we can say that something over the next 4 years, paying $7, growing at a rate of 3%, at a 4% discount rate, is worth $27.34 today. Let's try this again with one more catch. Just assume everything's the same, but we believe that we will have something worth $100 at the end of that. Well, since that's in the fourth year, we divide that 100 by 1.04 to the fourth power, and we get $85.48. So let's add that to the dividend and say the dividends plus this thing we think will be worth $100 in 4 years altogether is worth $112.82 today. Here I want to bring up the Gordon growth model, which grows out of the dividend discount models. Using the same numbers that we had in the last example, using the Gordon growth model, we can say that the price we believe the dividend should be worth are the dividend in 1 year divided by the rate of return, and subtract from that rate of return the growth rate. Now, what makes this different is that this isn't over a set period of time. This is assuming a perpetuity where you will just keep collecting that same growing dividend forever. So this doesn't have a time horizon at all, and is instead intrinsically based on the dividend, the growth, and the rate of return in order to derive a price. So continuing from our last example, we say the dividend next year is going to be $7. The rate of return was 4% and the growth was 3%. So we take $7 and divide that by 0.04 and subtract from that 0.04 0.3. What we end up getting is $7 divided by 0.01, which tells us that those dividends in perpetuity are worth $700. Now, there are different metrics that might be discounted to the present when analyzing a stock. One I have shown as an example is free cash flow to equity. Net income plus depreciation and amortization minus change in net working capital minus capex plus net borrowing. And that formula doesn't really matter right now. I'm just using this as an example of a cash flow metric that could be used in a discounted cash flow analysis. So what you could do is you would take that free cash flow number 1 year from now, bring that back a year, then add up all of those free cash flows you expect each year, bring it back by 1 times the rate to the power of whatever year it is, keep doing that until some year n, and you get the sum of all of them together. And that's the sort of general structure that underlies the idea of using discounted cash flows in valuing a stock. Now, different investors might have different metrics they're looking for, might discount different things, but this general formula of taking that cash flow value, discount it by the rate, and bring it back, and keep doing that for future values, just keep bringing it back, that is fundamentally what discounting cash flows is all about, and gets used quite frequently in the equity market. We've seen in these examples, like the Gordon growth model, a perpetuity. We've seen an example where there's a terminal value, that value we expect at a certain time period. And there are all of these variations, but they all ultimately come down to take a future value and discount it, bring it back. You may have also heard of stocks trading at multiples. These are also very commonly used in the valuation of a stock. So I'm going to go through some common ones and why they're used. So first we have price to earnings, which is what is the price of the stock relative to how much the company's earning. So how much are you paying for what it's earning? This is useful because ultimately the company is trying to make money, and you want to find out how much are you paying for how much money is being made. You'll also see this concept reflected in the earnings per share value, except this takes into account how much the share costs. The next is price to book, which are the net assets a company owns. When you strip out everything else about a company and just look at these are its assets, these are its liabilities, how much are you paying for those assets minus the liabilities? And this is very commonly used in value investing, saying what the company fundamentally owns. If I just bought this stock now, I'd own that. So how much am I paying for just that? Next is price to free cash flow. And free cash flow is that cash flow that's left over after operating expenses and capital expenditures. So this multiple takes that free cash flow value right now and says what is the price you're paying as a ratio of free cash flow. Then we have price to sales, and sales are a very important number for a company. Now this seems similar to that price to earnings idea, but when you go through a financial statement for a company, it ends up being a bit different. So this is saying, how much are you paying relative to the dollar amount in sales the company is generating? Next is one I really quite like a lot, which is the PEG ratio. And this is saying what the price to earnings ratio is relative to the growth of the company or expected growth of the company. So as price to earnings was showing how much are you paying for the earnings in the company, this is saying how much are you paying compared to earnings relative to how much it's growing, because you might be willing to pay a lot more for less earnings if the company is growing at a very fast rate and you expect those earnings are going to grow quite a lot. And you might not be so willing to and need a much lower PE if it's growing more slowly. Then we have debt to equity, which is the company's level of debt relative to the total equity in the company. So the equity is assets minus liabilities. How much debt, that debt liability, is there compared to that? Now, companies might be able to use debt to grow and get greater returns, but too much debt could also become very unstable for a company if they aren't able to keep up with it. Next, I'm going to introduce the idea of enterprise value. Now, enterprise value is the value of the corporate enterprise itself. It is the market cap, or the sum of all of the stocks, all that value, then add the debt to it, and take away cash, and that's the value you're left with, enterprise value. So enterprise value to revenue is that total enterprise value relative to the revenue it generates. Next, also using enterprise value, is enterprise value to EBITDA. Now, EBITDA is earnings before interest, taxes, depreciation, and amortization. This is a metric that a lot of people find useful for a more fundamental value of how the company's operations are. So this is using that same enterprise value and saying, what is that relative to earnings before interest, taxes, depreciation, and amortization, EBITDA. Now going back to interest rates again, what's the deal with that? No, I won't do that. Well, since a stock's value is tied to its expected return, and higher interest rates mean a higher risk-free rate, so you need a higher expected rate of return to take on more risk, then all else equal, this general rule applies. If rates go up, stocks decline, and if rates go down, stocks rise. There's a whole lot more to stocks, and this channel is certainly going to have it, so if you're interested in seeing that, then certainly please do subscribe. And other than that, have a simply resplendent day.